What up, y'all? It's your boy Degenerate coming at ya May 15th, 2019. Today, I want to talk to y'all about candlesticks. We've already talked a little bit about risk management and risk analysis, but when you're looking at a chart, how do you gain information from it quickly? And that is through candlesticks. If you're not looking at candlestick charts, you're doing it wrong. Gonna break it down to you as concisely as possible. Each of these boxes, let's get rid of this box and this box. But these boxes, this big rectangle here, all these smaller rectangles, the gray and white ones, these are all candlesticks that are based off of whatever type of chart you're looking at. So I'm looking at 1 month candlesticks. That means this candlestick represents an entire month. This candlestick represents the entire month of April. And this candlestick represents the entire period of March, February, January, December, so on. It's everywhere that price had traded during this month. So the way that I have my chart set up, and on TradingView you can customize it to whatever you want, any color that you want. I personally like white and gray, but I know white, for me, it means that the price opened at a lower price and it closed at a higher price. While if it's gray, that means that price opened at a higher price and ended the month at a lower price. These wicks, these long little boxes down here, price traded at that price at some point during the month. So up here, price traded in December of 2017. It opened at 10,000. It traded as high as 20,000, but then it closed at 14,000. January 1, it opened at about 13,900, 14,000. But someone during that previous month in December paid as much as 19,900, 20,000. And the same thing goes with January. Someone paid as much as 17,000, but price ended the month going into February at $10,000. I think that makes sense to y'all. I'm gonna leave it at that. But I want to get more into the theory of candlesticks now. We're gonna add to that concept and take it a little bit higher. It's great that you know that price traded there, but what does it tell you? It tells you that sellers came into the market at $14,000. That's how I'm reading it as. And it tells you that buyers came into the market in March or in February all the way down from $6,000 or $5,000, and they came all the way up to $10,000. Of course, the next month that was shattered. But if you're playing this monthly chart, this is what you're playing it off of. This is what your risk should be based off of. For instance, if this right here is closing, there's these things called bearish and bullish candle signals. In short, it's when you have a candle, it can be as long as you want, but the next candle fully engulfs it. So it opens at, for instance, right here. It opened there and it closed higher than where the previous month closed. Or if you're looking here, it closed higher than where the previous month closed. If you're looking here, it closed higher than where the previous month closed. Or if you're going even farther back into the charts, go back as far as you want. This, again, bullish. This, bullish. This not closing lower than this, still bullish. Okay, so there's like candlestick patterns that people interpret as bullish and bearish. I personally like these first three here. The hammers, the inverted hammer, the dragonfly doji. You can call it whatever the fuck you want. The same is opposite if you see the opposite of any pattern. This dragonfly doji is the same thing as a gravestone doji, just flipped upside down. The inverted hammer is the same thing as a hanging man. Your shooting star is the same thing as a hammer. These spinning tops, I don't agree with it. I think the market's really indecisive. You could base a trade off of it. Sure, 100, you can totally gamble on it. But do I take it as strong of a signal as the first three? I don't give it as much weight. No, not at all. So when you're looking, I'll link to this cheat sheet below in the description, by the way, so you can reference it as much as you want. But I'm looking mainly for these bullish engulfing candles if I'm placing a long trade, or this bearish engulfing candle if I'm placing a short trade. There's also patterns that you see that I'll link to this as well, where you'll see consolidation and you think, where should I put my stop loss at? Where should you buy at? And on top of all of this, you should always manage risk with all of it. If you're looking at monthly charts, you're going to have a lot larger of a percentage that you may be measuring when you're talking about proper risk versus, you know, this is going to be trading in a lot more of a range versus, say, something on like an hourly chart that maybe has 1, 2, or 3% represented per candlestick. Does that make sense? Because, you know, it's a volatile asset, and with more time, you see bigger moves. So if I'm looking at an hourly chart, I expect, like for instance, this is 1% from this open to close. But all the way from, you know, this whole entire price traded in a range of about 3%? I believe that's right. 76.29 to 78, like 40, like 3.5% max. Compared to on a monthly basis, you have just larger ranges. They would include all of this. Everything from down here at 5,400, 47% higher towards currently at like 8,100. So that's something that you have to keep in mind when you're looking at trades as well. If I'm taking a trade based off of an hourly candle, I don't expect to be in this trade for the monthly run. If I identified a bullish monthly candlestick and I wanted to place a monthly trade, sure, but I doubt I would be entering based off of an hourly chart. If I was entering based off of this and I was momentum trading, I would pull out a long position. And if I was trying to go with this whole entire chart, I would have my stop down here below where price is currently traded at. And if I was just going based off of the past hour, then I would have my stop 5 times closer, and risking like 80% of my account after trading fees, 75% of my account after trading fees, compared to down here where I'd be risking like 15 or 16% of my account. And you always have to ask yourself, is this a good risk to reward ratio? At this point, if I was taking an hourly trade on this and I said my stop loss had to be down here, to get that 3-to-1 risk reward ratio, I'm now saying that Bitcoin has to reach a price of like, where is this going? Like $9,400. Bitcoin is not traded at this price of $9,400 yet. So why would I take that trade based on an hourly chart? The answer is you shouldn't. You are longing into resistance. Don't do that. If it breaks here and you want to enter into a trade, you know what? Sure. You may have your stop loss like right around here. It's not a good risk to reward ratio. There are better trades out there that you could take. And if you just wait for them, they'll come to you. I'm going to point out a few of these candlestick patterns. The Dragonfly Doji is one of my favorites. You also see larger patterns that you'll see in charts. I'll link to this as well. But when you look at consolidation, for instance, if price is going up and it hovers at a spot, this is where you would create your stop, and this is the point where you would buy. The pennant going down like that, you bullish. This cup and handle, bullish. A lot of these, you might say they look the same, and you're right, they do. This is 100% trading with the trend. This is the trend. Upward is the trend. Upward is the trend. And you're looking at the trend. Downward's the trend. If you draw that line, it would hit this line and it would probably get rejected. Same thing there. Probably the same thing here. What is it? A right triangle? That's not bullish. That's bearish. So you got to keep in mind the trend when looking at the bigger picture. Let's see. I see. When you're looking at this right here, just quick pointing it out, these wicks, you can see 3 hours in a row, price tried to drop below 69.75, but it never closed below that price. If you were going to enter into a long here, that might be a good spot to do it at, because you see price continually rejected coming down. Buyers kept coming into the market. And if you were to take this trade based off of an hourly and you saw this, you would probably try to buy it around right there, or maybe you might try to come a little bit lower and you may not get filled. That's okay. You can stay out of the trade. But if you were really trying to get into that trade, your stop might be something like down here below this previous low. And at your 3-to-1 risk reward ratio, you end up something like right there. That is still in this current range based off of your hourly chart, and you see that you get filled. If you're going all the way to the top of this, that's your 4.5 risk to reward ratio. You're risking 2% of your account, you're aiming for 10%, and you got this trade in a matter of like 13 hours. That is sick. Or, the same thing if you were looking at a monthly trade and you saw something over here and you wanted to long this and you said, oh, hey, it closed above the previous month. That is bullish. That's a bullish engulfing candle. I want to long this. What do I do? And you could put your stop loss all the way down here if you wanted to, considering this was the previous low. You would be risking about 5% of your account, a little bit more, and your risk to reward ratio should be 3-to-1. And at that point, guess what? You hit it not in 13 hours, you hit it in 1 month, 2 months, 3 months. It took you about 3 months to hit that trade. But you eventually got your 3-to-1 risk to reward ratio. There's no right way to trade. No one can tell you to trade smaller time frames or larger time frames. It's based on your preference. Larger time frames trump smaller time frames though. If I saw something was bearish, do I project a 60% increase on a pump? No, I would not have that hypothesis. I hope you don't either. I hope you have some common sense there. But as you can, like, it works. And other people are trading the same exact candlesticks as you. Monthly candlesticks, weekly candlesticks, 1-day candlesticks. That's a time period where bigger players can get into the market. And if you're trading 7, 8 figures, you probably can't get in and out of the market in a matter of minutes. You could probably get in and out of the market with like a 6-figure account or a 5-figure account. But when you're talking about having $1 million worth of buys, you're not going to do that in 3 minutes and then sell it like 3 minutes later without causing some type of volume increase. Like, sorry, you're just not hitting. So those players will look for confirmation on bigger time frames. But as a smaller fish, you can totally play 5-minute charts if you wanted to. You could trade 10-minute charts. Whatever makes sense to you. Like, see this right up here? This had this huge wick up here. What does this look like? This looks like this shooting star. What happened on the very next candlestick came all the way down. What happened here? What does this candlestick look like right here? It looks exactly like this inverted hammer. What did price do after that? It rose. Again, you could look at this candlestick right here. It looks like a spinning top. Not my favorite. It is bearish though, and price did come down. Can you make a trade out of any of these? I don't know. But it at least gives you confirmation when you're entering a trade where you can then at least have a starting point of where you want your stop loss, where you want to enter in at, and where your risk to reward ratio is. And then all you have to do is wait and see it play out on the chart. I think I'm done for the day. I hope y'all learned something. I hope that if you have any questions, you reach out. With anything at all that you have, just let me know. I'll be more than happy to get back to you and elaborate on anything more. I'm going to link to the patterns and the cheat sheets below. If you need to, print them out. Hang them right next to your monitor. Consult them whenever you need to. Overall, I want you to trade safe. I want you to preserve your capital for tomorrow. And don't feel like you have to rush into anything, because that's when you do reckless shit. Anyway, that's it for today. The Boy Degenerate out.